Hey there, everyone. My name is Ryan Schewel. Welcome to my analytics channel. So in the project today, I want to show you how to look at BlackRock's investment funds, and we're going to go ahead and rank each single fund, every single one that we download from the website. So basically, we're going to create grouped composite scores based on several analytics that BlackRock makes available to us. And we're going to identify high-performing themes, asset classes, regions of investments, strategies for investment. Is it growth? Is it value? Is it income? Things like this. We're going to rank strategic allocations for the entire group. So every single one will receive a ranking. I'm going to show you how to do that. We're going to look at different categories and see which ones deserve higher rankings and higher weights or lower, and which funds typically are overperforming or underperforming or more or less volatile. We're going to look at things like this and understand the structures and the strengths and the weaknesses of these different investment strategies. If emerging markets show high composite scores but higher volatility, we can use these as tactical investment bets. That's one thing that we can consider. But if you're more focused on minimum volatility and high scores and more consistent and persistent returns on your income, then that could be more like a defensive allocation. That could be a different investment strategy. Okay, we're going to simplify complex data sets and make it very simple and very structured and easy to understand, and just make it easier to communicate the results to clients, right? If we have a stakeholder that comes to us and says, hey, I want to invest my assets into these classes but avoid these, I want high ROI, I want to achieve an investment return of at least 10% or whatever, right? That, like, we can customize that, we can develop that for the client. That's all highly customizable and highly doable. And we can spot opportunities for high appreciation, right? Or for overcrowded markets, right? If we want to avoid that, or if we want to engage in that, we can use that as a strategy. And look at high average scores over a whole group of investments. We have over 1,000 different investment opportunities here. I'm going to show you what are the best ones, okay? And let me just tell you, this is not investment advice. So if you invest in the market, if you choose to do that, you do that out of your own free will. And sorry, let me get some water. If you take a look at these bond funds I'm going to show you, each of these is a mutual fund that consists of different bonds. If you invest in that, you do that all by yourself. And if the investment doesn't pay off, don't come back to me and get angry or try to sue me or anything like that. I don't have any money. And all I'm going to do is just show you the finance, the math, the statistics, the computer science, the economics behind this, okay? And I'll show you I'll show you how to expose this and how to understand this in a simple, easy, digestible way. But again, like, I can't be liable if you make an investment and you lose money. Don't come to me and get angry about that, okay? Because I'm just going to show you the math and the statistics and finance behind it, but I can't give you investment advice here. So all the data comes from this website. I found this a couple of days ago. I think Monday afternoon I was playing around with this thing. So here you have different fund types, and I'll share this link with you at the end of the Jupyter notebook down here. It's right at the end. Okay, so you have that. That's the source of the data, right? Next to last cell, I have an end down here with the exclamation point. So, you know, that's the end of the project there. So let me just, sorry, let me take a minute and just take you through all the data here. So we have different fund types, different asset classes, right? And you can select these or deselect them or do whatever you want, right? So if you add more in here, you get these. We can go with mutual fund. We can go with all funds. Okay, I want probably like a bigger selection here. And markets, regions, I want developing, emerging, Europe, global, and North America, and sustainable, and uplift, thematic, and impact. Okay, so they make it very easy. You select these, then you click download, and you download as an XLS file. So I have several videos about how to screen scrape. So if you look here, you can actually screen scrape each one of these elements. If you go here, right click and hit inspect, you will see on the right hand side here what this element is. And as you put the mouse over it, you can see on the left this highlight over here, right? You can see when you move up and down, you can see these different elements. This is the next one right here. Right click to go to the element. Okay, and as you go through each one, you can see the naming conventions or the div elements. These are called HTML elements in the web page. So we can screen scrape all of this, but I don't know what the limitations of this screen scraper technology is. You'd have to go through and read all the details, like about us and all these things. Are you eligible for screen scraping? Are you not? Does it violate the use terms of the website? I don't know, but they give you a nice convenient button down here: download all funds XLSX. So that's what they did, right? So I don't have to get into all the screen scraping and create a lot of extra code. I can just focus on the analysis, the economics of finance, the math and the stats here. I don't have to get into all kinds of computer science programming, because when I download the file, I will literally see this right here. So this is the source of the file. All right, so we have a few different things. We have, let me see, what is this? 29 columns, okay? And if I go down here, 1,132 rows of data, right? So these are all the funds that we're looking at. And we have this, and I think if you click on this, it actually takes you to the web page. Okay, so that's pretty convenient. That's nice. So it gives you details about the fund. The NAV is a net asset value. 1 day appreciation is 0.09%. Almost 1/10 of 1%. Good job, guys. Good job. But over the year to date, so now is 6/11/25. So June 11/25, it's up 18%. So that's decent. That's pretty decent for this fund, right? So iShares MSCI China ETF up 18% year to date. So not a bad investment, right? You're doing good there. So here's another one, ECH. Let's see what ECH is doing. Okay, 26.42. So that's even better. Wow. So congrats. You guys are doing a good job. You're nailing it. You're knocking it out of the park. I'll share MSCI Chile ETF. So Chile is doing better than China. Let's look at another one. EFA. So what's EFA? What's going on over here? 18%. So a little bit less than the last one, right? This is MSCI EAFE. I don't even know what that is. I'd have to look it up. Up 5%. I mean, 1/2 of 1% yesterday, and NAV is 89. That's what costs to get into this fund per share, up 18%. So I have some basic information. This is pretty cool. This is pretty useful. So I have ticker, the name, the CDOL if it has one. This is the ticker symbol. So we have ticker and CDOL. ISIN is another identifier. These are all identifiers. Here's the QSIP. I worked in finance for a long time. I used to know all these things, but I forgot some of these terms. But these are all identifiers. So ticker, CDOL, ISIN, QSIP, all identifiers. So just put that in yellow. So this is how we can identify different securities. You need at least one of these. I think they're all going to have a ticker or plus ISIN or QSIP, but obviously they don't all have CDOLs, right? But I don't think anything is going to have only a ticker. I think you have to have letters and numbers to make it more unique. Whoops, skipped over here to the end. So anyways, let's move over here and just look at some of these metrics. So this is the inception date for the fund. This is when the fund started. We have the year-to-date return. Okay, if I put a filter on here, just want to scan through the data a little bit quickly here. So we have some with no returns. This is 29%. The top returning fund is 17%. Okay, year-to-date 17%. This is 1 year return, 3, 5, 10, and since inception, right? So it's pretty intuitive here what's going on. So this is down 11% since inception. This is up 14%. So not huge, but okay, there's a little bit of gain here. This is the asset class: equity, fixed income, sub-asset class, region, strategy, market, and then gross expense ratio. So the expense ratio is how much you pay to be in this fund, right? So the cost of doing business, or whatever, the management fee is 0.59%. So 1/2 of 1%, a little more than 1/2 of 1%. This is 0.6 of 1%, right? So these are the gross expenses for the fund. Anything that's basically an index or closely matches the index is going to have almost no management fee, because there's no work to be done. They just match the fund. I mean, like, they match the index that it tracks. So if it's S&P 500 fund, all they do is match what's in the S&P 500. They're not managing the fund. It's not actively managed. It's just tracking an index, right? So these have low expense ratios. Anything that has a higher expense ratio is a managed fund, right? So oh, this is a lot, 13% up to 4%. And if you look at some of these, So all of these, you'll pay at least 4% up to 13% for the fund to be managed by investment professionals. So they'll do a couple things for you, guaranteed diversification and professional money management, and they bring their expertise to the table. But I would question this, like this right here, year-to-date return is 0.4%, and they're charging 4.2%. So it seems like a scam. The one-year return was negative 3.94. Here is almost the same thing, negative 1.24% year to date, and they're charging you what, 5.72. So I mean, I would question some of these funds are actively managed. Like, what are they actually doing for you? Are they really making money? It doesn't seem like it. That's not the point of the video. I don't want to go down that rabbit hole. But let's continue on. You have performance at NAV. This is net asset value. This is the year to date, 1, 3, 5, 10, and since inception, and then performance price quarterly. So same kind of convention, NAV quarterly. This is the net asset value quarterly, and then the overview, and then the yield for each of these bond funds. Okay, so that's the background. That's what we want to get to and analyze. But the point is, there's a lot of data here. There's a lot of NAVs, there's a lot of quarterlies, there's a lot of YTDs and 1 and 3 and 5 and 10 year returns. And then we have the year to date return, 1, 3, 5, 10, and then the gross expense ratio. And we have, what did we see over here? So 1,132 funds to track, right? So it's a lot of information. How can we manage this quickly and easily and pick the top funds? I want to rank all of these. I want to rank the whole universe. How can I do that? That's the question. Okay, so that's the question I'm trying to answer. This is the source of the data. Let's jump into the analysis. So I go ahead and pull in the data from my desktop. It's sitting on my desktop. I saved it as product screener XLSX. And I have a header 01. And the reason for that is because they have some merged cells here at the top. If I expand this again and show you this. So this is a merged cell. How can I tell? Because I'm clicking on A1 and A2, and it just shows me A1, right? If I go over here and go to format cell, and this is how it comes, by the way. So I have no control over this. You have no control over it. Where's the thing? Oh, alignment, and go to merge cells and uncheck the box. Now I have A1 and A2, okay? So A1 is ticker, A2 is nothing. They merged these together, and I guess the reason for that is because over here they have a performance NAV, okay, and then they have a performance price quarterly, but they use the same header information. So here's YTD, here's YTD. Right next to it is 1 year percent return, and over here we have another YTD, right? So they use the same naming conventions at least 3 times. They just have different like headers over here. So NAV quarterly, price performance quarterly, and performance at NAV. And even these cells are merged together. And I can tell that because if I click on V1 through AB1, all I see is V1. Okay, so merged cells always have this property where it goes to northwest or the higher left-hand corner of whatever cell the merge starts in. So if I go to format cell and merge cells and unmerge, now I have all my unmerged cells. So V1, W1, X1, Y1, Z1, AA, and then AB, but they merge these all together, right? So I worked with Excel for a long time. In the Excel world, that's okay. You can do these mergers. In the Python world, this is really the bane of people's existence when you're dealing with merge cells, but there's a way to overcome it. You have header 01, everything in Python is 0 based, right? So you start with 0, 0 is really 1, 1 is really 2. In Excel world, 1 is 1, 2 is 2. In Python, 0 is 1, and 1 is 2, right? So I have to go ahead and import this data and use Open XL, okay? So I can import this data. These are all the fields that I see over here. I'm just listing off the field names, and then I'm doing a little cleanup down here to get the string names, strip out any kind of like weird spaces, or, you know, they put all these, you saw the merge cell things, so we have to handle that. There could be spaces. There could be cases where we have to do find and replace. I just want to clean up the naming conventions of all these cells. So once I get that, I can go ahead and append all the columns from this column list into separate and distinct columns, so we don't have NAV1 and NAV2 and or NAV, like it was repeating 3 times, right? You can't have that in the Python world. In Excel world, you can do it. It's very annoying, but for an Excel user, it kind of makes sense. For a Python user or for a database person, it makes no sense whatsoever. Like a database won't even allow that, right? And Python kind of conforms to the structure of the database world. So we have to follow those conventions. So we go ahead and get everything into a list, right? And then we parse that list into a list of headers that we can use over here. So we have ticker 0, level 1, name 1, level 1, 2, level 1, 3, level 1. So it looks a little weird, right? But that's okay because it comes to us very weird. So we're trying to standardize and normalize everything so we can actually use the data, right? Because if I just suck all the data from Excel, now where's that file? Let's go down over here. Oh, it's over on my desktop. Okay. So if I use all the data in Excel exactly like it is, that's never going to work in the Python world, right? Like Python wouldn't even know what to do with it. It's going to throw errors and it's going to crash. So we have to do some cleaning. We have to get this parsed out from header 0, from this is basically row 1 right here, from row 1, which is really 2 rows, because this is 2 rows over here. That's the problem. We can't just chop this off, right? Because then we lose the headers on the right-hand side, and we certainly can't chop this off because this has most of the details of what we need. So granted, this looks a little bit weird, but this is probably the easiest way to do it, and it definitely works. So once we get it into a structured format, we have MHCI iShares US 6719. If you look over here, US 6719, if I parse that out, the QSIP is B671. Okay, so that matches up. The date is 3/29/2011. Okay, so that matches up. So I'm pretty confident here this is working. We have a gross expense of 0.59 and 12.53. So if I scroll over a little bit, so I see 0.59, 12.53. So we're looking good. Let's go to the end. And basically the rule is if the first couple work, then everything works. Okay, so you just have to just have to eyeball a few of these for a sanity check. So 20, 25, 6, 8, and 0 time, and 19, 19281, and 12. So that's what we're looking for. Do we have 25, 6, 6? So June 6th, 2025, which was a couple of days ago. Now it's June 11th, 19, 281, and 12. Do we have that over here? If we do, then I think we are in good shape. Yep, June 6th, 19519. 281, it's represented as 193 over here because of the formatting. We go to 2 decimal places, but 19281, and we have a 12. And if I go down, just go down 5 rows because I'm only showing the first 5 in the header. We end with 02, so same date, June 6, 1932502. 19325 and 02.02. And if I go on this line over here to the left, we are looking at EDEN and B523. Okay, so EDEN, B523. Go to the left. And I say EDN, B523. So we're in good shape. The rule is if a couple of these work out, they all work out. Okay, once you understand the convention, like everything underneath is just going to flow. So I think the data frame is totally fine. So we have to do a little more manipulation here just to get it slightly more standardized. I want to get all the asset classes named. Okay, so analyze all the distribution of asset classes, sub-asset classes, the region, and the strategy in the market. So that comes from here. So here's the asset class. If I spread this out just a little bit. So we are looking at these columns right now. So we have asset class, sub-asset class, region, strategy, and market. So we're looking at these columns P through T. Okay, so I want to go ahead and understand these different levels of investments or these different types of investments. Which country, which strategy do they engage in? What's the asset class? What's the asset type? Things like that. And I'm going to go ahead and create a visual and then actually rank all of these asset classes too after applying a filter. So I'm doing a DF filter by column. These are all the columns. Okay, so these are all the columns. The value counts and ascending, false or default. So basically, we're just taking and counting up all these items over here. Okay, so if you look closely, and if I put a filter on here, I'll just put a filter on everything, I guess. So data filter. Actually, there's another way to do this too. So if I go to asset class, I can insert pivot table. And I used to do this all day, every day. This, I think this is fine, yeah. Oh, it has to do this, okay. Yeah. It's complaining because there's no there's no legitimate header, okay. And then it has to go down to here, and there's no bottom. Okay, so I think this should work. Oh, because it's missing some name. You know what? I can just do this. It's totally fine. Better anyways. Okay. So if we go down here to asset class and then values, this will count up all the asset classes. So basically, this is what we're looking at. There's 6 cash investments, or 7. There's 520 equity, fixed income. That's what this is doing over here. So for all the asset classes, I want to do counts. Here's equity, 520. I just showed you that. Fixed income, 338. Okay, multi-asset, 233. So 233, 338, 520. 233, this multi-class, 338, and 520. So that's what this is doing. It's basically taking, kind of doing a pivot, not really pivot, but counting all the items, and then it's creating a chart of each one, okay? So we have all the investment types. We can see equity is the most popular one here. Let me see if I can get this. Really, you can. Oh yeah, there it is. Okay, so we can expand all this. We have the equity, fixed income, multi-asset. We have the counts of each one. So AC cap, sub-asset cap. All capitalization, I guess. Target date, large or mid-sized caps. So large cap of these big companies or the mid-sized companies, things like that. North American funds, global. And then we have, whoops, sorry, what was that? Okay, it's very sensitive. So North America, global. Then we have distribution strategy. So you can see the breakdown here, a little bit hard to read, but you know, we can actually zoom in and get like the top ones over here. That's what I love about Plotly. Like, it's very interactive, right? So some of these have no labels. This is defined contribution, college savings, generating income. So different strategies of investments, right? And then distribution of the market. This is in developed countries or unnamed. Why does it keep skipping like that? It's kind of annoying. Okay. I guess when you go too far down the page, it just does that. Okay, so that's pretty good. So we have all the counts of all the different types of investments. But now how can we go through and score all these investments and figure out what's the best one, right? Because when I look at this view right over here, this is a lot of information. This is too much information, this TMI. I'm looking at all these different funds, 1,133 minus the header, so 1,132. And then you have all these metrics over here, different asset classes, subclass, strategy, market. That's what I just showed you. But here's the performance for each one. So the year to date, year, 3 year, and then since inception, and the performance quarterly, then the NAV quarterly, and then the actual NAV, and then the change, and then the yield, the 30-day yield, and then the distribution. It's like, what the heck? Like, how do I even begin to even comprehend all of this information? It's a lot, right? And my first look at it, I was like, what the heck is going on here, guys? Like, how do I even get my mind around it? But I thought about it, and I came up with a ranking strategy that takes a lot of information and reduces it to a very simple formula. And this concept is kind of used by portfolio managers. I used to work as a PM many years ago, more than 10 years ago, and very interesting business. I worked with all kinds of asset managers, investment managers, hedge fund managers, capital markets, all these guys. I helped them all over the place, mostly United States. Most of them were Northeast, but yeah, all over the place, just to do similar types of analysis. So this is not something that I created or invented. It's kind of common, but not everybody uses this concept at the same time, right? Like, it is pretty popular, but I'm not saying this is the only way to do this type of analysis. But I think, like, compared to a lot of things out there, I think this is very interesting, and it's obviously very affordable. I used to sell these tools to asset managers and hedge fund managers, and we would charge a lot. We would charge anywhere from $100,000 for a very basic service up to easily $1 million. You can spend $1 million, way over $1 million per year. This solution is 100% free, guys. Zero. It costs $0 to utilize this strategy. Okay, so I think it's really worth it, because if you pay $1 million for this service, for the data and for the analysis, and the tools to do the analysis, right? You have to make at least $1 million just to break even. And even if you make $1 million, you have to pay tax on the gains. So you probably have to make 1.5 million just to break even. That's a lot of money, right? If you make $1 million, this strategy is totally free. You can pay your taxes on the gains and then put the rest in your pocket. Okay. So how do you do that? So we have a start column and an end column. Gross expense ratio unnamed 20 level 1. So that basically comes from here, right? If you go back over here, gross expense ratio, and if you go back over here, this is what it looks like in Python. Gross expense ratio unnamed level 20 level 1. And remember, the 20 comes from the column number, right? They increase as they go over. I just had to come up with a system that assigns unique, non-duplicative names, and then assign some kind of identifier at the beginning. So this is performance at NAV, and you can see how it goes over here. And then performance at NAV, performance as of, price performance quarterly, as of. So the names just have to be unique. That's all that you need over here. And I just need numeric names. So we looked at the counts of all the asset classes and the asset strategies right here. So we're done with that. Now we're looking at everything that's numeric from the start column to the end column. This is yield, premium, discount. That comes from over here. So yield, premium, discount. This is the yield. So that's like the parent header, and this is the premium discount. So that's like the child or the sub header over here. And if you go all the way to the right, yield, premium, discount. So basically, this is the beginning and the end of all of the numeric columns. Okay, starting with, where is it right here? Gross expense ratio. It's literally all these columns over here. That's anything that's not a date. So we're taking all the numerics, right, and applying a little bit of business logic to all of these non-date numerics that right down here. So we have the start columns, okay? If I do Control F, we start columns to end columns. So we have the beginning to the end. We apply PD to numeric, and we use coarse to coarse everything to be numeric if it's not. So it should be numeric. When I look at those numbers, they look like numbers. Sometimes they come in as strings. Sometimes they come in as like all kinds of crazy non-numeric things. We want to convert that to numerics. Then we get the numeric columns. We fill out all the columns. Anything, everything has to be filled in. If it's not filled, then we fill it automatically, and we fill it with a mean. So we just want something in there, because a 0 or a blank is just nothing. We don't want that. We want some kind of numerics in those columns. And if you look closely, some of them do not have numbers, right? So like some of these things just don't have numbers, and that's just the way it comes in. But we want it to just be cleaned up, straightened up, tightened up a little bit. And then we're going to compute a z-score to get everything standardized so all the metrics are on the same scale, right? So if you have a big metric that's $1 billion, a smaller metric that's 1,000, these numbers are very different, right? But once you scale them, I have specific videos on how to do standardization and normalization and scaling. Everything is on the same relative scale, so you don't have massive outliers on one end and little tiny little mouse things on one end. So you're not trying to compare an elephant and a mouse together, because they're totally different. But everything is, if it's on the same scale, you would say, okay, like an elephant is bigger than a mouse, and a mouse is smaller, but they're somewhat similar. But we know that the elephant is bigger, right? But it's not like this gigantic thing that's hard to compare to a little tiny thing over here. We just want to scale everything so it's all relative to everything else. So that's how we get the z-scores right here. The numeric columns filled divided by the mean, which is the difference of all these numbers, divided by the standard deviation. So if I go down here, I have the formula for z-score. The z-score is basically the z, which is the value being evaluated, okay, minus the mean score divided by the standard deviation. So in just a couple of lines, all the magic really happens here. So we get all the z-scores for everything in this whole universe. We have the actual numeric that we're comparing to, the mean of all of those, divided by the standard deviation, because we want to see how broad or how tight all of these numbers are, okay? And this is similar to, what is it called, Sharpe ratio, where you have the number, you have the average of the number, and the standard deviation. I think that's how they calculate it. I think it's almost the same as the z-score. I haven't looked at it in a while. I used to do a lot of work in that area. So forgive me if the numbers are a little bit off, but it's essentially the same concept, right? So we get all that when we create a composite score. So all the magic happens basically in just a couple of lines. We convert everything to numeric. We take the mean numbers, okay? Then we take the number that we're evaluating, subtract out the mean just so we can see the relative difference, divide by the standard deviation so we can see how spread out these things are. Then we can create a composite score, and then we will actually rank all of those numbers. Okay, so we have the ranked funds. So we take all of this and we create a new column in the data frame, append that to the data frame. Here's the business logic down here. Again, it's all the numerics. So everything from everything from here over to the end, minus the dates. So we have about 37 columns of numerics. Again, getting the z-scores and appending new columns based on that. So if I go over to the right, I can see the whole thing in this view. So we have the fund name, we have the gross expense ratio, just to prove that this works. Okay, all I really need is composite score and the ranking, but just to prove for specificity and just for peace of mind, I'm looking at the gross expense ratio. Lower is better, right? So the lower the expense, the higher the ranking. So I'm just looking at 3 metrics here, but everything is based on those 37 metrics, right? So we look at everything. I'm just looking at some 3 that kind of stand out to me. So the lower the expense ratio, the better. The higher the yield to date, the better. And the overall performance, NAV, net asset value, the higher the better, right? So this fund right here gets the number 1 score, ranking 1, and gets a composite score of 6.3. So this is actually the best fund to invest in based on the expense ratio. It takes 0.3 of 1% cost to run the fund. So that's it. That's pretty cheap. The year-to-date performance is 1%, and the 1-year performance is 13%. So you're basically making 13% return, and you're paying 3 cents on the dollar. 0.3 of 1% on the dollar. That's pretty cheap, right? So that's why this gets a composite score of 63. So again, all the magic happens in just a couple of lines. We can first convert everything to numerics, fill in all the columns, get the z-scores. Based on the z-scores right here, we sum up all the z-scores, get the composite score, get the ranking based on dot rank. So we took all these columns of data, I forgot how many, 37 numerics and 1,100 different funds, and we got the top fund. So this is the number 1 best fund, ranked number 1. This is number 2 based on the composite score of 61. So the expense ratio is a little bit higher, 0.25. Performance is quite a bit better, 11%, and the performance 1 year is 54%. So that one's pretty good too. Composite score is slightly lower in rank 2. Number 3, to round out the top 3. Here we have iShare MSCI Europe Finance. So pretty low expense ratio, 0.48. This is almost 1/2 of 1%. The year-to-date performance is 35%, and the 1-year performance is 38%. This gets a composite score of 0.49 and a ranking of 0.30. So you see the top 10 over here. This is the top 10, and this is the bottom 10. So within the top 10, the number 10 is iShares Gold Macro, 9% of 9/10 of 1%, 25% return year to date, and 34% 1-year return. This is 38 composite score, ranked 10. This is the bottom 10. This is the top of the bottom, I guess. So New York Income Fund, 3.94%. So now I'm paying 3% to run the fund. It's actually generating -4%. So that's kind of dismal. And the 1-year return is 1.39. Composite score -29, and the ranking is 11250. This is the absolute worst in the bunch. iShares lithium miners and producers. That sounds awful to me. You're mining lithium, and who knows what you're doing to the environment. 0.47%, so 1/2 of 1% to run the fund. And you're paying that no matter what. And they're losing 18% for you and 41% 1-year return. So I can see why this is coming in dead last, right? -64% composite score and 11340. Okay. So again, what are we doing here? We're taking composite scores, looking at performance year to date, 1-year percent return, gross expense ratio, but all the other metrics too, like the 3-year, the 5-year, the NAV, all the changes over time. We're taking 37 metrics, dumping it into a blender, grinding it up, creating composite scores, and just a couple of lines of code. I think there's 3 that really do all the magic. And now you have the top funds in the whole spreadsheet, right? Like the whole universe is 1,100 funds. I think that's what it was. So if you just want to use only the 1-year return, so this is another metric that you can look at. I've tried this in the past. It really doesn't work that well because you're always kind of chasing the wind. You're always looking backwards. And I can tell you exactly what happened in the entire stock market yesterday. That's easy to do. But can you translate that to today? What's going to happen? Not necessarily. And can you take that and make predictions into tomorrow? What's going to happen tomorrow? No, that just doesn't work. Like the past is the past. These trends tend to repeat somewhat, but the trend is not your friend. There used to be a saying on Wall Street. I don't know if they still say this anymore, but the trend is your friend kind of thing. I used to believe that, but after doing years and years of analysis, I don't believe that anymore. The trend is not your friend. The trend is a trend, and your friend is your friend. The trend is not the friend. But if you just wanted to look at the performance and say, what happened in the past will continue into the future, you could do that. And you could say, okay, this guy generated 54% last year. It's probably going to continue. Well, maybe not necessarily, right? I've tried these strategies. It's very simple, very straightforward. But the problem is the market is very dynamic. It changes all the time. New information becomes available. Traders digest that. Money managers assimilate this information, and they'll make their trades according to what they believe in. There's a lot of investor psychology that goes into the market. It's just hard to predict, right? So the trend is not your friend. If you want to just look at the 1-year performance and just engage with that, this is how you would do that, okay? I wouldn't recommend that. I would recommend the composite score that I showed you before. But if that's your thing, then so be it. So this is just one more metric to look at average composite scores by class. So digital asset, the average is 16%. So this is a good place to be. This is a good place. Hedge fund of funds, commodity funds, equity, and private markets. And it goes down to fixed income, which doesn't perform nearly as well as digital assets. So the next subclass is precious metal, 38%. And this is the plot of the same thing, right? The last one to come in here is target date. I don't even know what that means. Private equity for fund co-investment. I guess that's 3.2. That's over here. So that's 3.29. And then what else we have? Whoops. Well, this thing is very sensitive. Okay, so we saw those. Okay, so composite score of region unnamed. So Kuwait, global, North America, Asia Pacific. These are the returns of those. Oh, composite scores of those, sorry. And we have composite scores by strategy unnamed. So, well, this is getting to be annoying. I don't know why it's doing that. Okay. Well, we're almost at the end. So anyways, so we have composite scores of the by strategy and factor, multifactor, factor, core equity, factor. You can read this. I don't have to read it to you, right? And then the last thing here is developed or emerging. So that's what I wanted to show you. The magic comes from just a couple of lines of code to create these composite scores. Basically converting everything to numeric, filling into numeric columns and getting the z-score to standardize everything. This is how you calculate the z-score right here. It's this metric right here. So this is one strategy. Again, I'm not saying you have to do this. I'm not saying this is going to make you a mega billionaire, but using this strategy, this is the best fund. This is number one, easily the top ranking funds. These are the top 10 right here, right? With this being number one, this is number 10 down here. And that's it. I just wanted to take something that was fairly complicated when you look at that, because when a human being looks at this, you can't tell me when you look at this entire spreadsheet what the best investment is, right? You do not know that. There's no way a human being is going to know that, right? But when you take this, all this stuff, this is a lot of gold nuggets in here, and you mine it and you sort through it and you look for these little nuggets and you come up with this being the number one investment strategy. This is ranked the number one. I think that's pretty cool that you're able to do that. So that's what I want to showcase today. That's what I want to demo. I will wrap it up here. Hopefully I was able to drop some knowledge that is useful and helpful and informative. Try to make all my videos very interesting and engaging and educational. I think there's two ways to make to make content on YouTube, to make two ways to engage with your audience, to make it educational or to make it what's the other? Entertaining. I think entertaining and education pays off on YouTube, and there's probably others like, oh, I don't even know. What would the other categories be? Not sure. I'm sure there's some other categories, but I think the most successful are education and entertainment, right? So I try to make all these educational, every single one. I put a lot of time and effort into it. Try to make it a little bit entertaining. I don't know how entertaining it is listening to a 53-year-old guy talk about finance strategies. I don't think that's entertainment necessarily, maybe for some people, probably not for most, but I try to make it at least educational, maybe even inspirational. Maybe at some level it's inspirational too, but that's my goal. If I can do that, then mission accomplished. Okay, I'm gonna wrap it up and I'll see you guys in the next video. Talk to you soon. Bye.